Welcome to the Daily Brief, where I'll go over the highlights for the action in the market for Friday, December 9th, and then we'll see how things look for Monday, December 12th. We had another down day. We pretty much gave back on Friday what we gained on Thursday. It hasn't really changed our technical picture other than the ADX is still a little bit positive, hasn't quite crossed back over negative, and I'll show you a chart of that. But other than that, pretty much all of our charts, in fact, all of our charts are negative currently. So going into next week where we're going to have the CPI release, that's a biggie. And we're going to have the FOMC come out with their decision and then the press conference after that. That's a biggie. You're seeing below average volume leading up to that. You're seeing folks really apprehensive of taking big positions before that. And then we'll see if this coming week can try to make things a little bit clearer. So what happened on Friday? Right at the open, we had a flat open. We opened right about at the daily pivot, and we went a little bit above that at 39.58. But anytime we started to come down, the daily pivot provided support. As the day went on, prices tried to advance, but never even got to R1 at 39.80. For the rest of the day, prices pretty much chopped sideways, but we did see some late day weakness. We closed below S1 at 39.42. That's where S1 was. The close was at 39.54. We were down 0.73% on below average volume. Our technicals are still pretty much negative right now. Everything is pointing down. There's a few exceptions, but these tend to be more outlier type of indicators that we use. The trending based ones are pretty much pointing down because of inflation and interest rates. And that's still going to be the big deal this week, unless some of the other stories or the list of issues that we have, if one of those comes to the forefront, that could change. But right now, it looks like we're going to be focused on this whole Fed speak and inflation and interest rates in the upcoming week. So here's the chart where we had pretty much of a flat open. We stuck along the daily pivot. Anytime we tried to go below that, which is kind of positive, we were able to use that as support. We tried to break up higher, never got up to R1, came back down to the pivot, just danced on it. Look at how there's really no movement going on in volume. It did pick up closer to the close, but then going into the close, we saw some weakness hitting the market. So we closed down below S1. What are some comments that we can make? The PPI was stronger than expected, and that gave the backdrop of the more negativity, which we've already been seeing in our charts. The CPI and the FOMC, this will all happen in the upcoming week. We have the equity put call ratio. It continues to advance, and it's still pretty high. And I have a chart to show you of that. The dollar was up a little bit. That gave some pressure to stocks, even though they haven't really been keying off of one another lately. And interest rates rose yet again. They haven't been really keying off each other in the last week or so. The charts are negative overall. As far as an extreme negative reading, we do have the Stochh RSI, the Williams percent R, and the stochastics. Two of our three stochastic charts, where I have the three charts on one page, those are extreme negative. These are all short term. They're really touchy. They tend to move pretty drastically no matter what's happening. And we were just extreme positive recently. Well, now we've dropped back down to extreme negative. We don't have any intermediate term charts that are extreme currently. We still have the 10 to the 5, the 10 to the 2, the 10 to the 3 month, and the 30 to the 5. Those yield curves remain inverted, and they've been that way for quite a while. Sentiment finally ticked down a little bit. We had been positive, where now we're ticking back over into the neutral land. The PPI, when it came out, it was up 0.3% on a month-over-month basis. That was greater than the 0.2% that they expected, and it was the same as the last time we had this report. On a year-over-year basis, it's up 7.4%, which is lower than the 8.1% that we had last time. If you take out food and energy, it was up 0.4%. And this was a real concern to the market because that was double what they had expected at up 0.2%. The last time we got this, it was up 0.1%. On a year-over-year basis, it did drop a little bit to 6.2%, where last time it was at 6.8%. Wholesale inventories were down 0.5%. The last time we got this reading, it was up 0.8%. And then consumer sentiment, it was at 59.1. They expected it to be at 57, so a little bit better than expected, but 59.1 is nothing to brag about. That's still pretty low, but it at least is coming up off of being extreme where we saw it earlier. The last time we had this report, it was at 56.8. And then a year ago, just to give you a little bit of clue, we were at 70.6, so quite a bit higher than where we're at now. Our trend is slightly positive, and I'll show you that chart, but it is weakening. We're below 20 and declining. Our bias is negative with the majority, in fact, 4 out of the 5 trading days this week were negative, and our momentum is negative also. So here's an updated chart of the model that we've been looking at. If we want to compare 2006 through 2008 to where we're at right now, I did get an update of this as of the 9th of December. It's showing how the S&P is starting to weaken. That's the white part of this chart. And are we going to match what happened back in 2006 to 2008? You could make a stronger case for that now than you could just a few days ago. And then this is also an updated chart. I finally found one on the VIX where the white line is where we're at right now. And we were getting pretty complacent. The reading was quite low, but it's starting to go back up slightly. If we stick to what's happening here, we should see the VIX really rise, and that happens when stocks start to fall. So these two charts would suggest that we're probably going to go lower. A few days ago, it didn't look like that was going to happen. Now you could make a stronger case for that to happen. And some of that hopefully will be decided in the upcoming week. Here's the consumer sentiment where it came in at 59.1. Still pretty low and still pretty far away from the 2-year yield. We're seeing a pretty solid spread between them on here. And usually they have a tendency to stay closer to each other, and they tend to move in the same direction, where the 2-year yield and sentiment are going in opposite directions for the most part. Here's the stochastic chart showing the short and intermediate term. And now remember, this whole chart together is short term. So I'm just breaking down and further subdividing the short term. So we have extreme negative, and then we're starting to turn lower with the long-term version of the short-term chart. How's that? Yeah. Okay, here's our ADX where the green line, it declined, but it didn't decline as much as the red line. So it's slightly positive, but both are going down and the ADX is going down. So that is a weakening trend. Here's the BPI, still hanging in there for the most part. That could be seen as positive, but after we have some kind of an extreme reading, extreme positive, look at what the S&P did after that. Are we going to see that same basic scenario with the chart this time? Here's our double and triple exponential moving averages, where we're still holding up okay along the double exponential moving average. That's the blue one. Are we going to be able to bounce up more positive from there, or are we going to break down below this blue line and head lower? All the other charts that we look at suggest that we have a real likelihood of going lower, understanding that anything can happen. Equity put call ratio, even though it declined and then came back up, it looks like it's not that big of a deal compared to the spikes that we've been seeing, but this is still a really high reading overall. You're seeing a lot of puts being purchased rather than calls. Then here's our 5-day simple moving average of that same chart, where it continues to advance and getting to a pretty extreme reading. But we've seen this before. Typically what will happen is this will spike up. We hit a bottom in the market. Everybody's getting out. It's capitulation. And then we just go up from there. Well, look, we've been getting so many signals in 2022 that have fizzled out after we have had them. And that's why we've had such a difficult environment. All right, here's our daily chart. We closed down below the monthly pivot here. So that is taking on more of a negative tone. Here's our moving average tree. This is more on a positive side. Even though we declined, we're still above the 100-day moving averages, both the simple and the exponential. New highs, new lows. We're seeing a real contraction in new highs, not really an increase in new lows, but overall we are decreasing with the 5 period and the 10 period. Here's the fib, short-term fib levels. Nothing's really been decided here. We might see some support coming in at this 50% retracement level. If we do end up going higher, we might see some resistance at one of these levels in here. So there's significant overhead resistance and support right now, and we're kind of right in between them. Here's the longer term look, also kind of in no man's land in between either support or resistance. Then here's the weekly chart, where it was much more positive a week ago when we closed above this 40 period moving average, which equates to the 200-day moving average. Well, we gave that right back in this past week, and now we closed down below that 40 period moving average. So what's our outlook then for Monday? The technicals are negative. We have the final IHS Market Services PMI coming out and factory orders. And then the big one will be the ISM non-manufacturing index. Then the whole list of geopolitical events, they're all in white, meaning that they're happening and they do have an impact. But the gold ones are what the markets are really fixated on right now. With inflation and interest rates, oil, it was up a little bit in Friday's session, but it's still dropping overall. It's into the 70s. And then any Fed speak that comes out, not before the meeting because they're on lockdown now, but the statement that is issued, and then after that, the Chairman Powell's press conference. So our scenarios can't really go with the down one yet, even though our technicals are pretty negative. We're not really trending. We're just chopping sideways. Can't go with the positive one because everything is pointed down. So we're still going with the sideways scenario because the ADX is weakening. It's still below 20 and it's slightly positive. So our conclusion, the S&P is negative, short-term negative and becoming overbought. We have a number of our short-term indicators that suggest that. Intermediate term, it's just flat out negative, and long-term continues to be negative. We got above that 200-day simple moving average. That was helping things to improve slightly. We've now dropped below it, and we've stayed below it. So that's shifting things even more negative after the improvements that we had been seeing. So have a great weekend. This will be the only video that I do post. We haven't really changed as far as the weekly outlook. We're still more negative in that regard. And the intermarket analysis, that hasn't changed in a long time either. So have a really good weekend, and I will talk to you in the next video.